Hello, fellow traders. 'Tis I, the Rumpled One, coming to you June the 5th. The year's 2019. Let's talk trading. Finding certainty in an uncertain market. Yesterday, I talked about buying it, and I said, you really can't buy certainty, but there are some things you can find that are certain, such as if the market's open, price is going to change. That's just the nature of the market. For the most part, price is going to change. Now, I'm sure there's some stocks out there that are very, very, very lightly traded, and on any given day, they might not move at all. Or they might wind up where they started at, and it looks like they didn't move, but they made a high, they made a low. You see, you can be certain that when the market opens, there's an opening price, and that sometime during the day, price is going to make a high, and sometime during the day, price is going to make a low for that day. Now, sometimes the high could be the open, and sometimes the low could also be at the open. But we know price ranges, and therefore, price moves. It just moves. We know that. Sometimes, some days more than others. We call that volatility. We see that in the range displays that I show when I see how many pairs have moved 100 pips or more when there's only about, 6 hours or so left in the market. Now, the thing about certainty is that, if you don't use good money risk management, then you're probably going to wind up losing. And if your method doesn't give you opportunities to take profit, you're going to wind up losing. And if your execution and performance isn't up to par, you're making mistakes, you're late, you're early, chances are you're going to wind up losing. Now, on the flip side, through repetition, it's going to give you confidence and competence because you have success. And this is a cycle. So if you do something and you have success, you make your first trade and it's profitable, or you trade your first week and it's profitable. Now you have a little confidence, and you just repeat this process. And as you repeat it, you become more and more competent. At least you should. Some people keep making the same mistakes over and over, and they become competent in making mistakes. But let's hope you're not one of them. And as you know, it all gets back to the money and risk management. So if you have your risk management in place, you've got the confidence, because the worst thing that's going to happen is you're going to lose a certain amount on that trade, whether it's a pip, $1, $10, $100, whatever your risk is, 1% of your account, 0.5%, 5%, once again, whatever it is you're willing to lose on any particular trade. And so we're talking about, how do you find certainty? Well, as I mentioned before, there is an open price, and we know price ranges. We know it goes up, we know it goes down from the open, because everything's measured from that opening price. And that open is arbitrary. Yes, I agree that. Just like if I want to, I can say, well, this is when I brought up this profile, so everything is relative to this price here, 121.64. And as you can see, price moved away from it, and it's still moving away. So price is going to move away from the open, either to the upside or to the downside. That's just how it works. So what do? Well, we can take certain measurements from the open, and we can say, chances are if price comes here, it's going to go somewhere up here. Or if price comes here, it's going to go somewhere down there. Based on math, it's the range. The difference between here and here is 20. If we know the average range is 50 or 70, we know you can't put 50 or 70 in the 20. It's going to stick out one side, the other, or both sides. It's just simple math, simple geometry, simple physics. I mean, it's simple logic. It can't be refuted. It's been proved mathematically. I think I may have told this story, but I actually sent this idea. I was speaking with a corresponding, I think it was some college professor in France, and he said that this is mathematically sound. Why was it? Why did I have to, you know, use a college professor in France? Well, it's because there was a theorem or a theory or a proof. I can't remember exactly. I don't even remember the name, but basically, and I'm sure if you go back and look at some of my old buy zone posts, I explain it all there. But that's been over a decade, close to 2 decades now. But it's a mathematical proof, and it's well known. So the buy zone basically relies on that proof. It's just simple. You can't fit 50 in the 20. It's going to stick out. You can't put a yardstick in a box that's 12 inches long. Yardstick's 3 feet. It doesn't fit. So this is what I'm talking about. So, and that's a certainty. That's how you find certainty. Certain. We look at the previous day's high and the previous day's low. If price hits it, well, one of two things is going to happen. It's either going to continue on or it's going to reverse. So when price reaches the previous day's high, there's an opportunity that it could go up X number of pips. Now, look at here. We've got a range of 65. So right now we're 7 pips off the low and 58 pips off the high. You can look at it here or you can look at it here. And you can look at it here. It just depends on where your eyes are at the time, what your focus is on. Point being is that when price went from the open to here, that's only a 10 pip difference. And from here, that's only 17. So if price went down and came back here, that's 18 pips. We know the average range is somewhere between 50 and 70. That means there's pips to be made. And you can see here, 57 minus 9, what's that? 48? There's 48 pips potential in that one trade. That's just using math. Is that certain? No, because right here you can see there wasn't that big of a move. And here it got close, but it reversed. So same thing. But so you can be certain that at any level, price is either going to go up or down from that level. The only thing is, which direction do you trade in? So do you trade knowing that there's a certain range, and if it goes here, chances are goes this far, chances are it might go this far? That's up to you. But it's, once again, it's certain from a statistical standpoint. And just remember, these videos are for educational purposes only, and your results may differ from that of the presenter, which would be me. But looking here once again, price went up, price came down, touched a line, price goes up. And you can see this, it doesn't even matter the time frame. The same thing is true. Here, price went above this wick, top of that candle, right? See that wick? What happened here? It came back down, left that wick zone, and it went to the downside. So certainty, well, I know price doesn't like staying in the wick zones, especially on lower time frames. I mean, here's one right here where price wound up in the wick zone. Well, what happened? Price entered that wick zone and then it left it. Price doesn't like staying in the wick zone. In fact, I think I just got an idea for an indicator. Well, actually, I think I already have that indicator. I was thinking have a multimeter that shows if price is in the wick zone of the previous candle. So actually, yeah, I've already written that indicator. Might have to put it up on the screen. We can trade with it. And once again, what do we know? We know range here. You see, we've got an average range of the euro yen, 70 pips. We've got a maximum range of 235 and a minimum of 19. So what happens is if we've got a bull candle, green candle, up candle, whatever you want to call it, we add the average to the low, and this is what we get, a target here. And you can see we had a target of 122.31. We had a high of 0.258, so we missed it by about 6 pips, 5 or 6 pips, close enough to take profit. And here you see we have the maximum range, so we're looking for price to get in that area. But it doesn't have to be profitable, especially we can see here. Let's extend this chart. Looking for that break. Now here, the day before, didn't have as much of a break. Over here, it didn't have that much of a break. But you can see here we had a nice break. Day before we didn't. So once again, you see something. Oh, day before we didn't have much of a break, then we had a break. Day before we didn't have much of a break, then we had a break. So once again, finding certainty. Is that certain? Don't know. Haven't run a frequency distribution. Don't even know if I need to, but I might. So it's just something to look for. So right here, did price test the high before? On this one, no. Did it test it? No. 2 times it didn't test the high, then we had a breakout. Did price test the high? No. Got close, but this time, you see here, it's 3 times, 4 times. Barely tested it, then we had a breakout. So you can look for things like that to see maybe there's an opportunity. Certainty. We can be certain price is going to range from the open. We can be certain that price will put in a high and low and then move off of that high and low. That's the whole idea behind the rat zone. And we can look at different levels. So here's the 1400 candle. I like looking at that range and using that as a trigger. And you can see here, once again, it proved to be profitable. And somebody could go, well, you could do that on any candle. Ah, that's the point. You can do it on any candle. Just sometimes some candles prove to be have a slightly better statistical edge than others. And we can always go back to something that's really simple, and you don't even need the 3 balls, the ZZ indicator. You just trade with the H1 candle color at the line. So, or you just trade from level to level. Price is in this level. It's not going to stay there. It's got to either come here or here. So price came here, comes to this line, you take the trade, you win. Price didn't stay in this level. I mean, any level, you look where it opened, see it left there, and then it went up. And if you see if it tests one way and doesn't break the level, then and it starts coming back the other way, well, then it must be heading the other way. Simple. So remember, It's not what you trade, it's how you trade it. Drain the banks.